Welcome back. This is Open Exchange. We are coming to you live from the CNBC TV18 Motilal Oswal studio. Well, we're getting into pre-open now, but for the time being, let's get in some derivative strategies. Manoj Muralidharan joins us to tell us exactly that. Hi, Manoj. Morning. What's your view on the index, as well as fill us in with your strategies?
Good morning, Nigel. We all know that this monthly expiry would be on Wednesday. So we have actually seen the rollover pick up. The Nifty is at a good 18%, and the Bank Nifty is already at 25%. So we believe that the Fed futures that we have would see good buying even in today's trade. So 18,080 happens to be the support for the day, and we believe 18,170, a good 110 points, and the upside might be the resistance. But there is importance to the option data that we see, and the max pain says that the expiry can be closer to 18,130, 18,130 as a spot. Now, stock specific also, we believe there is good buying which is happening yesterday, not only into the private sector banks, like even Anuj was mentioning that. But then there are two other stocks which has been outperforming right from October, November series. So we like ONGC, which can be bought with the Fed futures around 147. The stop loss should be 143, and we expect close to 156, 157 as a target in that. Second would be Tata Steel. We believe that 120 to 121 becomes a good buy even in today's trade. The stop loss should be 116, and the stock has a potential to go to almost 128 to 129 at least as a short-term target of the stock.
Manoj, stay with us. Actually, I'll tell you why. Let's just, this is Market Laser. And let's just quickly highlight the stock that I'm going to present is Tata Steel itself. Again, it's breaking out. I mean, simply put, maybe just about for the first time after 8 months, starting to get its shine back. Now, what you're seeing on your screen is this downward sloping trend line, which has been in place all the way from the all-time high on Tata Steel, which was made in August of 2021. All right. About 153, 155 or so was that level. As you can see, it's downward sloping. It's held all the way. There were a couple of attempts to take this out in March of 2022. And since March, it's been 8 months. In between, the stock got to lows of 80, 83, bounced back all the way to about 115, sold off once again to sub 100, another bounce above 100, sold off to under 100, and now finally we are back at this trend line once again. Actually, as of yesterday, it depends on how you draw it, but as of in intraday trade yesterday, we actually went above this and then closed slightly under it. Of course, I mean, fundamental factors we've been kind of highlighting. There was that CLSA note. Nigel has been talking about it. Global macro factors, which is, of course, the dollar being extremely weak is another powerful reason why. Metals perhaps are a sector which perhaps should be on your radar. Will it fail this time, or will it continue moving higher? I think that is the question on Tata Steel. But perhaps, I mean, after 8 months, you get a bit of a move here. Manoj, the call was on Tata Steel. Is the F&O side of things also looking good? And any additional thoughts? You have that as a call, but anything else? Yes.
Yeah, Prashant, that's a very good observation. But Prashant, ideally, this move in Tata Steel started all the way from 106 to 108. So if you just go back just 2 months, October, November expiry, I believe the strong hands of the institution side, when they enter into a stock, they choose arbitrage. A fresh arbitrage is when you buy the stock futures and you see a relevant positioning in the current month future. So Tata Steel, I guess we have seen huge delivery-based buying, which was consistent even when, if you believe, just 2 months before, the metal sector entire was underperforming, and then October onward we saw the traction coming. So Tata Steel at 106 weighted average price, that comes with the concept. We believe there is been huge infusion into strong hands, and this stock has a good potential of almost 138. But then obviously, because we're into derivative trades, we give you a short-term target because that would be pertaining more to the expiry. But then yes, 106 to 138 happens to be the true standard deviation move the stock has very much. Now, there are a couple of two stocks also which has got into this. Tata Motors at 384 to 388. The same concept of delivery-based buying with the additional positioning in the futures have been seen for Tata Motors, and ONGC at 136. So these three stocks we believe have been seeing the same pattern, and this has a good move of at least 18-20% in the short term.
Okay, well, thanks a lot for that. Let's just get to the pre-opening rates. By the way, you have a lot of stocks actually. Put your focus on, say, an IndusInd Bank, Persistent Systems. Persistent Systems is in the green at the moment on the back of a good set of numbers. IndusInd Bank is down about 4.5%. And you have something like an Adani Enterprises on the back of that FPO that is sulking a bit because perhaps of the floor price being around 3,100 or so. But let's move on. The government's increased thrust on infrastructure development is likely to come as a shot in the arm for capital goods engineering companies. Harshit Kapadia, the Vice President, Industrial, Consumer Durables and Electricals and Renewables. So he's tracking a lot of the buzzing sectors. He's from Elara Capital. He joins us now. Harshit, good morning and thanks for joining in. I was going through your recent note on capital goods and you point out that this is the highest order inflow that the sector has seen in the last 8 years. Across most companies, Siemens, KEC, Kalpataru Power, large orders are being booked. So tell us, from an investor standpoint, where do you see the maximum growth, both in terms of price appreciation as well as valuation headroom?
So morning, Sonia. So in terms of growth, we are seeing a lot of new sectors rising, and the capex in terms of large quantities being started to flow. Let's say starting from railway as a sector, moving on to even renewables and defense as well. So those are the key sectors that we are looking in terms of where more order inflows are expected, given the government is very aggressive in these three sectors. And in terms of valuation, there is further room for valuation upgradation as your order book is going to an all-time high. Further, there is a scope of increasing, and everybody's getting a pie of it because the project size are also increasing and more number of projects are coming.
Hi Harshit, good morning. Harshit, just want to focus on Havells for a bit. The numbers are expected today. What are you penciling in?
So I'm penciling in something like a 10% kind of a growth for Havells. We are certainly looking at on a Q1Q basis margin expansion, given one of the segment called as cable and wires is looking to see a strong expansion in margins, given the material prices have been stable, so that should help them get back to a higher margin. And there have been some price hike within the sector as within some of the segment which Havells is operating.
Okay, you have buys on a lot of these, defense names as well. There is, I'm just going through your list. There's Bharat Electronics, Bharat Dynamics, Hindustan Aeronautics, Garden Reach Shipbuilders. Tell us about what kind of upsides do you see here, and how much of the order wins, the good news is already in the price.
So in terms of upside for most of the players is about 20%. The largest one is in Hindustan Aeronautics. Part of it has been priced in terms of what domestically is expected, but most of the orders on the export side is something that we are expecting should come in 1 to 2 years time frame. So that should help them further re-rate the sector. Apart from that, there are a lot of programs on the indigenization side, which will also have benefit to PSUs as well as private sector, which is also further going to help order inflows momentum to continue in the defense side.
Names like Voltas, do you have any view?
So presently, as far as consumer durable is concerned as a sector, right now the demand has been quite weak as far as EC is concerned or the other consumer durable is concerned. So presently, we have a hold rating on Voltas, but Q4 onwards, when the summer season starts, picking up, one can look at Voltas, and that's where the demand is expected to revive, and the price hike may also happen, where most of the players are struggling in the market.
Harshit, briefly we talked about Siemens. Now, are valuations a problem? I mean, Siemens now trades at what, 55, 56 times earnings. If you just go back and look at where valuations were 2 years ago, right? Actually, look at in the middle of 2019 before COVID, right? There's been a huge re-rating. Irrespective of what is it pricing in, basically, is the question.
So largely the capex, which is being, so if you look at post-COVID, the capex cycle has improved significantly. And that has been the key reason. And Siemens has a larger exposure across multiple sectors. So the growth momentum is going to continue, whether it be power, be it be real estate, be it be railways, the major sectors or the manufacturing sector. So all the sectors are very much aligned to Siemens, and a recent announcement of Siemens getting much bigger on railway should help them get more pie of what the railway capex is right now giving.
Okay. You have reduced your exposure on BEML. Why is that? Is it purely because of the amount of price appreciation that you've seen? And what are the triggers there?
So the reason we have a reduced rating is because we saw the order inflow momentum for BML being slowed largely on the metro side. So some order which were expected, which where Alstom has actually got some orders. So there has been metro is moving on a slower track, whereas defense is still continuing the momentum it is. So the trajectory was more towards metro. Hence we have a reduced rating on BML. But once the disinvestment news also, revised, there could be a chance of re-rating. So disinvestment is also another reason where things are moving on a slower track.
Okay, all right, Harshit. Thanks so much for stopping by and filling us in with your take on the space, as well as a couple of stocks as well that we discussed. Disclosures come up for you on the screen. But it's 9:10, so let's get in our technical expert. Sudarshan's back with us. Sudarshan, what's your call at 9:10?
Petronet is a buy with a stop under 216.
Okay, and that's Petronet. So let's just get that up for you. Mitesh, what about you?
I will go with the buy call on Steel Authority. Keep a stop below 89. 96 should be the first target.
Okay, that's a buy on sale. Asian Paints is rising ahead of its numbers today, so just keep an eye out on that. And a couple of other names. There's a downgrade on Titan from UBS, so just pull up Titan for you. That stock a tad bit all over the place. You're under a bit of pressure right now. Persistent Systems as well, sulking a tad bit despite good numbers. But IndusInd, let's find out more about that. Abhishek is here. Abhishek, over to you.
Well, brokerages are saying that, the bank is delivering on the guided path. Core operating profit growth and credit cost has surprised them positively. The risk reward is now favorable in terms of valuations. However, the key monitorable near-term event will be the CEO term extension. Remember that Mr. Sumant Katpalia's term ends in March 2023. So whether RBI gives, an extension of 1 year, 2 year, 3 year, that will depend or find the next course for the stock. So ROE recovery is on track. Pockets of weakness is seen in consumer banking, which remain concerning. MFI book has deteriorated. Management has guided that it will normalize in 1 or 2 quarters. The target price from brokerages range from as low as 1,386 per share to as high as 1,550 per share. All of them remain bullish on the stock. Back to you.
Abhishek, thank you very much. That is IndusInd for you. Titan is the other one where there is that upgrade. Mangalam is here with more. Mangalam, hi.
Well, there's a downgrade on Titan coming in from UBS. Although, there's nothing new that they're saying. They've cut the target price from 3,000 to 2,600 rupees. They're saying that, the rise in gold prices and depleting pandemic savings will impact grammage growth, as a result of which they see weak jewelry growth in FY24. Titan already is trading at 56 times FY24 earnings. So Titan has never been cheap, and it's the valuation headroom that they're worried about. However, in the long term, they do expect Titan's jewelry business to remain strong, given one, inelastic wedding growth that we have in India. Secondly, gold as an investment asset. And thirdly, low share of organized jewelry market. So the macros are rather favorable for Titan, but just the near term, because of rising gold prices and the valuations at which the stock trades, we can see some bit of a downtick perhaps.
Okay, thanks a lot for that. Well, we are heading into the opening, which could be a bit under pressure, down almost about 50 odd points on the Nifty, holding on to 18,100 though. And the pressure is coming in from Adani Enterprises on the back of the FPO. There's Titan on the back of the downgrade. There's a couple of these names. HUL ahead of its numbers is sulking a tad bit. And some of the steel names, JSW Steel, Tata Steel, maybe just coming in for a little bit of profit taking after the recent sharp run up. NTPC, Asian Paints on the upside are moving up with some strength. And then you've got to watch out for names like IndusInd Bank as well as Persistent Systems on the back of their numbers. The global cues are also a bit on the lower side today, not just the handover from the US, which was quite weak. The Dow was down 600 points, but a lot of Asian markets are also sulking ahead of key data points that come out later in the next couple of days.
When we started, Sonia, the SGX was indicating a 100-point downtick, just 50 odd points. Let's see.
Yes.
it's perhaps cutting its losses. Now the first tick on the index is down almost 65 points. So it's a slightly weakish start, you'd have to say. The Bank Nifty is down about 150 points and the advanced decline ratio is well in favor of declines over 1,100 stocks. The big losers, IndusInd Bank is down about 1.5% post its numbers. You have Titan that's down about 1% post the downgrade. There's Hindalco, JSW Steel, Tata Steel, maybe some profit taking there. And Adani Enterprises on the back of the FPO is down almost 3% In fact, the entire Adani group is under pressure. Adani Ports is also down about 0.5% or so. Bajaj Twins also sulking. Bajaj Finserv is down about 0.8%. And IT is coming in for some profit taking. HCL Tech, Infosys, Tech Mahindra are all down about 0.5 to 2%. On the upside, Asian Paints is going into its numbers strong, up about 1% over there. Dr. Reddy's, Cipla, Sun Pharma, all the pharma companies are doing well. A defensive move perhaps. HDFC Life, UPL also looking pretty good. Axis Bank, ahead of its numbers later, is up in the green, a tad bit in the green rather. And something like a Sun Pharma is up about 0.2%. But it's not a bad opening, you'd have to say. Compared to what the SGX was suggesting, the Nifty is quite resilient. And that has been the case for a while. So let's see if the dips get bought. In the broader markets, of course, a couple of these names like Goa Carbon reacting well to their numbers. So Nigel will talk about that. But for now, the first tick is down but not out, you'd have to say, on the Nifty. Down less than 50 odd points. Not a bad outcome considering the global cues.
Well, that's right, Sonia. Let's run you through a couple of result reactions. And Rallis is getting clonked, actually. That's down, I think, in trade. Remember, there was weakness in their numbers due to erratic rainfall in the domestic market. There are headwinds in the export market as well. That's down close to around 5.5%. Persistent Systems, well, that's down close to around 1% odd. The numbers are fairly okay. Oracle Financial Services, so that's up close to around 1% odd. Mahindra Life Spaces, well, they're going to be taking a redevelopment project here in Mumbai. A revenue potential of around 500 crores. So that stock should be up for you on the screen. I think it opened up, pre-open it was in the green. So that's up close to around 2.5%. Adani Enterprises, news of the FPO. So that stock, I think, had pulled back a little bit in pre-open. It's down close to around 2.5%. Vedanta, successful bidder under the corporate insolvency resolution process for Meenakshi Energy. Stock opens high with a gain of close to around 0.5% odd. So we had an initial dip. We were down 65-70 points odd at the start of today. We're pulling back a little bit. Let's see how it goes on the index. Prashant?
Yeah, absolutely, Nigel. 40 points lower, 18,124 is what we have on the index with 2 minutes, exactly 2 minutes of trade. Just a few other names. Rallis, as Nigel pointed out, is the big cut, 5.5% odd. That is kind of opening up like how ICICI Lombard yesterday opened up with a sharp cut. Where is ICICI Lombard? Actually, we should have that up as well if there is any follow-through. I think we had a technical call from Mitesh earlier. That is starting about 0.5% lower. Adani, I think as we mentioned, Adani Enterprises is down 2.6%. Adani Green is down about 4.25% as well. In terms of sheer volumes, these are the two names which are coming up with maximum volumes and the biggest price action as well. Avenue Supermarts is down 0.75%, 36.21 on Avenue. Polyplex, I think, saw a sharp move yesterday. It's down 1.6 to begin with. Info Edge Naukri is down about 1.25%. Adani Transmission is another one which is down 2%. So that is a pack which is seeing some selling. Tata Communication is down about 1% or so. Coforge starts down 1%. Cochin Shipyard starts down 1%. Birla Soft is down about 1%. But these are, not backed by volumes which are still kind of lacking. So I guess give it some more time. Persistent is now the top volume-led gainer. It's already had a bit of a U-turn. The low was 39.20. It's moved up about 60 rupees since open in the last 2 or 3 minutes. Sula continues its march higher. So the big move was on 16th. Then you had a bit of a quiet day. Yesterday we had a very large move. And I think we ended 6% higher on Sula. It's at about 413. From its listing price, it's up now 15%, almost 15%. Tata Elxsi is another one which starts 1.6% higher, 3681. So it's moving up and picking up pace. Surya Roshni is another one which is backed by volumes, 2.5% higher on Surya Roshni, 620. Hindustan Zinc, backed by volumes, 1.6. Hindustan Zinc was up in the last a couple of hours yesterday, closed strongly. So it's got some follow through. Goa Carbon, there is Kohinoor, is it Kohinoor Foods, I think? 12% move on Kohinoor Foods, 74 or so is what we have. So That's basically the lay of the land. 1:1, exactly 1:1 is the advances to declines ratio. And all said and done, after the first 3-4 minutes, we got 40-45 point, lower start, neither here nor there. Sonia.
When you mentioned Sula, are you trying to say that as it gets colder in Bombay, people are drinking more wine? It's gaining so much ground, right?
It is.
But Metro Brands is another one. I mean, the market is definitely rewarding companies that are delivering good numbers. So Metro Brands is also putting on some weight. And after persistence good showing, a lot of the other mid-cap or non-index IT stocks are doing well. Tata Elxsi is gaining some ground. So do keep an eye out on that as well. But I think we have Harold van der Lind, who's the head Asia equity strategist at HSBC, who joins us now to give us his view on all things markets as well as the way forward for Indian equities. Harold, always a pleasure meeting you. Happy New Year to you. Hope you have a great 2023. How are you feeling about global equities now?
Well, happy New Year to you all over there. How do I feel about equities at the moment? We feel quite positive about equities. I think we've seen a shift in markets, and that is driven by 2 or 3 things. First of all, we've seen a shift in inflation expectations in the US. That is starting to come down. You guys have talked about that quite a lot. The second shift is, of course, that we've got changed policies in China. So the idea is that some of the precautionary savings that we have in China now might be unleashed to the rest of the region and in China itself. People go back to restaurants and travel or hotels, buy stuff again in shops. And I think the third thing that is happening is that there's a feeling that you don't want to be underweight on Asia anymore in general, and that people need to buy stocks in this part of the world. Probably for those 2 reasons I just mentioned beforehand, inflation expectations and growth in China help a lot. So, that makes us positive on China for the moment, or on Asia for the moment.
Hi, Harold. Good morning. In your note, you've mentioned that you're fairly, positive on your preferences for markets like China, Hong Kong, Thailand, and India. Is this an order of preference? Does India come at the latter part in terms of preference in comparison to the other couple of markets?
No, it's not really an order of preference. It just happened that it was actually created as such. But I do think that India will attract a different kind of investor maybe than the Chinese. Of course, emerging market and Asian investors will go there. But the story in India differs a lot from the story in China. Although at the moment China is bouncing back a lot and there seems to be some more visibility, I think if you go beyond the bounce in spending, there is the outlook in China is rather foggy and murky, while in India, I think it's much clearer. So it depends on the kind of investor you have and what you prefer.
All right, Harold, what about on the Indian markets? Are you working with some kind of a double-digit return for this year itself? That's by the end of 2023. Do you think that the Indian markets will be 10% higher?
I think the Indian markets could be more than 10% higher by the end of this year. Why is that? Now, the very simple reason is that although there's a lot of attention now being paid to China and growth coming back in China, China at the moment is forecasted to grow 16%. Now, I suspect that number could go up. But India is expected to grow by about 20%. India is going to grow even faster at the moment. As I said, maybe these numbers will change a little bit, but India is still going to clock in some pretty decent earnings growth numbers this year. The multiples are a bit hefty. India is not cheap, it's expensive. So they might come off a little bit, but I don't expect a hell of a lot. So double-digit returns in India, we view, is possible this year.
Yeah, guys, Harold's moniker, he goes by the name The Flying Dutchman, right?
Yeah.
Harold, you're doing a lot of flying these days? Or no?
Well, actually, it's been more the grounded Dutchman over the last 3 years, right? The travel over the last couple of years, I have not been really out of Hong Kong to most of these places for 3 years now. So I want to go back to India soon.
So yeah, absolutely. I would love to have you here in the studios.
Right.
Just when something becomes consensus, almost consensus, I mean, not that consensus can't be right, but this thing that China is for the short term, India is for the long term, is almost, I don't know if I've not spoken to enough people to say it's consensus, but nearly enough, because we speak with experts like you every day. It's almost, we hear it every day. You think, I don't know, I mean, I'm just throwing that your way. Does it necessarily have to pan out that way? What could be different?
Actually, I think that's been the story for the last almost 20 years already. China's for the short term and India's for the longer run. If you look at the performance of the Indian stock market of the last decade or 2 decades, has been just phenomenal. And China has not done as good, but there have been bouts of trading where you could make a lot of money in China. If you go back to 2016, 17 in Chinese equities, we had a similar situation of bond yields starting to come down, inflation coming down in the Western world, while China was recovering after some stimulus being put in place. That market went up 75% over a period of 2 years now. Things might be slightly different this time around, but similar dynamics are in place. So we shouldn't ignore China at the moment. This is the time to be overweight on China. But you're right. There is a difference between the two in the way you trade them. That's absolutely correct.
Okay, all right. So I got that point, and yeah, returns kind of bear that out over the last 20 years, as you said. The kind of stocks now which will do well. There is growth. When we say growth, I mean high P stocks. I mean, India has always been an expensive market, and that is also you can go back any point in the last 2 decades, and that statement, I guess, will be true, relative, of course. But are valuations in the growth names, I mean, secular kind of stories where there is this compounding which has been kind of built out, made out. People are questioning locally. Local investors are questioning whether this buy at any price because they've compounded for 10 years, 15 years. Will that continue? Right? These are largely in the consumption area. Any thoughts, Harold, there?
No, two thoughts on that. First of all, if you look at the earnings profile in most markets, and India is not an exception here, it is healthcare, consumer, discretionary, and these sort of companies that do very well. So you want to have that domestic exposure in India, as you want to have it, for example, in China as well. And some of the sectors you highlight right here. The other thing is that as global bond yields fall, the discount, this is a bit technical, but the discount that we attach to value created in the future falls. And that means that value in the future rises because the discount is smaller that we attach to it. And therefore, yeah, it's growth stocks that do well. And you can see that. You see that, for example, in tech stocks start to outperform across the world. For example, in China, it's China Internet that's doing very well. And India fits that particular profile as well. It's these high P, these long-term stories, like some of your paint sellers or companies that sell biscuits and whatever, that could perform very well in such an environment as well. So there's good reasons to believe that that might be the place to be at the moment.
Okay, well, I want to take that point, scratch that point a little more. By the way, just wanted to mention to our viewers, draw your attention to Persistent Systems, which is now at the high point of trade. So definitely the dips are getting bought here. Good set of numbers, no complaints at all. And the market likes that. 3% higher now on Persistent Systems. And IndusInd Bank as well has moved, from the lows. The dips are getting bought there. The stock is now at the high point. Harold, the IT space is a sector that you've tracked for a very long time back home in India, and you've been investors, large investors in a lot of these names, Infosys, TCS. What have you made of the recent correction that we've seen? There is an impending global recession as well. From the management speak, we understand that client spending is getting delayed. Decision-making is getting delayed for sure. Do you think that there is still some more caution to be exercised here, or is this a good time to be loading up on the large cap tech names?
I think so. The story that we get from these Indian companies mirrors very much the story that we get, for example, out of Korea and Taiwan, exporters there. For example, quite recently, a Taiwanese bicycle company has said that payment terms are shifting. People want to pay later, and the orders are being cut, and these sort of things. So you get a very similar story. Global demand for products out of US and from US and European customers in particular is weakening. And inventories tend to be high in some industries. That means that the order flow that these companies get is going to be weaker. And I suspect that's going to persist for a little bit longer. But we gotta throughout this year, we gotta see how much further downside that means for these share prices, because some of these companies have already underperformed. They're quite weak, and if we see any sign that the demand is not worsening further than anticipated, that might be the time you want to go into those stocks. But for the moment, I think you want to be careful with globally exposed exporter companies.
There are, in fact, Harold, there are some signs that demand is perhaps not worsening further. That's what the large cap tech companies have told us, that demand is stable. Of course, as they head into a recession, you never know what takes place. So at this point in time, are you as a large investor looking to put money to work here?
I am generally still skeptical about some of these stories. I can see that at the moment in certain products, demand is okay. It is really where you, for example, in tech products that are being exported, where you have a lot of high inventory. In IT, you don't really have that inventory issue as much as, for example, in some of the tech names that the Taiwanese are exporting. But I still think that the risk could be on the downside from the US and European customers. While on the other hand, the visibility I have on your domestic-oriented sectors is much better. So I still prefer that domestic story, but maybe that will shift as we go deeper into 2023.
Well, Harold, coming to India, I think the top stocks that you like is Reliance, Infosys and HDFC. But you've also mentioned that industrials as well as discretionary pack, you'll have some preference out there. Any stocks you could name?
I think India stands out in the sense that if you pick stocks in whatever sector you go for, in India, you pick the ones that have been the winners over the last couple of years. Now, this sounds obvious maybe to you. So, of course, these have been winners. You stick with them. So you buy those industry leaders. But this is actually not as obvious as you think it is, because in a lot of other markets, it's the other way around. In China, very often, you want to buy the number 2 that is becoming the number 1. There is a lot of shift in positioning. But in India, some of these brands, domestic brands and companies with strong channel distributions, they have been consistent winners, and I think that will probably continue for some time to come. So whatever you want to go for the ones that the number 1 and 2 in those particular industries. Maybe in certain cases, but generally speaking, that works in India.
So just one last thing for a lot of viewers who are watching. I mean, they can get exposure to things like the Nasdaq, etc. They've got sort of local mutual funds which offer Nasdaq ETFs, right? You earlier mentioned as interest rates fall, the growth stocks do well. I mean, would you recommend getting exposure to US tech as well via this route?
If you're in the US, then yes, I would say that is something you favor. But generally speaking, we favor the emerging market space over the developed markets, equity markets at the moment. So I would say if you can play it in Asia, and you could do that quite easily out of India by, for example, buying some of the tech stocks here in India, or you could do that elsewhere in the region. Think about some of the Chinese internet names or so. Then I would favor that, because I think there's more upside into that, and than developed markets.
All right, fair enough, Harold. We'll leave it there. Thank you very much, and I hope from grounded you're able to fly again, and you don't remain grounded. And as you said, I hope India is the top of the list when you firm up those travel plans. Thank you for joining us here on CNBC TV 18. Thank you. Manish Sonthalia is now joining us. He's head of equities, PMS, Motilal Oswal Asset Management Company. Motilal, of course, is one of the mutual funds which has got a popular Nasdaq ETF. Just talking about that with Harold. Manish, good morning. Great to have you with us here on the program. Just your thoughts on the market itself. We're now about a week and a half away from the budget, so we'll, I guess we have that to contend with. But how are you feeling about things? We got a brief bout of underperformance relative to the globe. Is that getting behind now?
Yeah, China is being bought into, and India not so much of an inflows into the new year. I think the key point to note out here is that ever since the Fed has articulated that the Fed funds rate can top 5%, it clearly means that there does not seem to be too much of an upside in India for the immediate term. Of course, second half of the year, you'll be looking to cross that 20,000 on the Nifty. But I would say at the current moment, there's not too much of a downside. There's not too much of an upside. It's going to be, pretty sideways market for the time.
Okay, a pretty sideways market. But within this range-bound market, Manish, there are plenty of pockets that are outperforming. IT has started to perform in a big way. And as we speak, Persistent Systems is up almost 4%. Tata Elxsi is rising ahead of its numbers. Do you like any of these names? If yes, which ones?
So technology has gone through a time correction as well as price correction, but even after the fact that the recession commentary has been there for the last 11, 12 months, we actually have seen top line numbers come for most of the IT companies that have reported so far, and so top line growth estimates have been met, margin numbers have been met, and valuations have corrected. So in that backdrop, it seems like that technology is bottoming out. And 2 quarters down the line, we'll all be looking at FY25 numbers. So it's not going to be only FY24, it's FY25. In that backdrop, wherever there's valuation comfort, whichever stock is not overtly overvalued, so to speak, is likely to outperform. Very difficult to say whether they'll make absolute returns, but relatively technology is going to be an outperforming sector. On the back of turnover numbers having got met, even in a weak quarter, furloughs, etc., margin numbers have been met. And the outlook for 25 seems to be better than FY24, where all the low growth estimates have got priced. So, within the large pack, we do have liking for companies which are there in the mid-teens. Even the large cap names like TCS and Infosys, some allocations could be made there.
All right. Hi, Manish. I think you guys were positive on Zomato earlier, and the stock gave a good bounce. But suddenly that supply has again hit the screen. You believe that Zomato still is good from a longer term? And any other of these new age themes you'll have got into? Because quite a bit of selling has come about, be it a Nykaa, be it a Paytm.
See, Zomato, I think we're quite positive on Zomato. It does not really matter who is selling or who is buying, as long as there's fundamental value in a particular company, it will find capital. So at 50 rupees or even at 60 rupees, we think that most of the negatives that were pertaining to the stock, when it comes to overvaluation, all got factored in. The key thing to note out is whether 16.8 crore orders, which was the run rate of orders last quarter, whether that run rate is getting met. That is to say 70 crore orders annualized is coming about or not. And whether contribution margin of 17 rupees per order, whether that is increasing or not. And I think from the next 3 years perspective, the 70 crore orders would likely be closer to 150 crore orders. And the contribution margin of 17 rupees per order is closer to be around 25. In that backdrop, given the valuations of sub 50,000 crore or thereabouts market cap, with 11,000 odd crores of cash in the books, I think there's ample value in Zomato. It's now bordering value stock rather than a growth stock. And so from that perspective, clearly are positive from Zomato, even if, let's say, Alibaba has sold some stake. So this name is clearly something which we are liking. We're also working with Paytm now. I know, we are still doing our maths out there, our numbers, but clearly again, there you have Alibaba selling quite a bit. And after that 75% being a platform technology company and still having a revenue model with bulk of the expenditure having been taken care of, I think the growth can be quite non-linear. Even in the case of Paytm. So within the new age companies, I think we are working with Paytm and Zomato, and we like both these stocks. In my portfolio, I specifically have Zomato. I'm doing some more work on it.
All right, Manish, thanks very much. Good speaking with you. Appreciate you joining in with that perspective. So that's Manish on markets, and he likes Zomato and Paytm as a house both, but he owns Zomato in his fund. We'll take a break here. We are back. We have the management of Blue Dart joining in to talk about whether that slowdown that we've been hearing on from companies like Delivery, etc., on the e-com side is entrenched, or are things looking up? So we have the Chief Financial Officer of Blue Dart joining in for that. Later, we analyze the expectations for the steel sector in our special quarter the segment. Of course, we'll be joined by discussion with Amit Dixit of ICICI Securities. Stay with us.